We're analyzing SBA Communications, stock ticker SBAC, to see if its market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for SBA. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing SBA Communications for your portfolio. Before we get into these valuable metrics, let's understand SBA's stock performance. Right now, SBA trades for $239.59 per share. In the last year, their stock price is down 30%. This underperforms the S&P 500. In the last 5 years, SBA's stock price is compounding at 9% annually. In the last 10 years, they're compounding their stock price at just under 13% annually. Going back prior to the global financial crisis, over the last 18 years, SBA's stock price is compounding at almost 20% annually. The company's stock price is up more than 27 times in this period alone. Additionally, SBA is a REIT. They pay dividends. Right now, SBA pays a 1.24% dividend yield. Their average dividend yield throughout this time frame is in addition to these compounded returns in their stock price. But why should we be paying close attention to SBA? SBA trades just $3 above their 52-week low. Only 1.5% of their shares are sold short. SBA is a large business. They have a $26 billion market cap. SBA Communications owns and operates almost 40,000 cell towers throughout North America, South America, and Africa. It leases space on its towers to wireless service providers who install equipment on the towers to support their wireless networks. The company has a very concentrated customer base, with most revenue in each market being generated by just the top few mobile carriers. The company owns more than 17,000 towers in the United States, which accounts for about 3/4 of the company's total revenues. Internationally, SBA's greatest presence is in Brazil, where it operates roughly 10,000 towers. SBA generates revenue from two primary businesses: site leasing and site development services. Starting with metric number 1, usually for a REIT, we want its average return on equity to be above 9%. For SBA, due to their accounting and due to their debt loads, which we'll take a look at later on, we're going to be using return on capital here instead. We're looking for this to be above 12% on average over the last 5 years. During this time, SBA has grown their returns on capital. They had a low of 6.5% in 2019. Since then, they've been increasing these. Averaged out in the last 5 years, SBA earns about 8% average returns on capital. This is below that 12% mark we'd be looking for. Also, because of both their debt and their accounting, they've had negative return on equity in all 5 of the last years. This is an X on metric number 1. Metric number 2, we're looking at the high-level growth of the business. We want to see growth in their revenues and their cash from operations in the last 5 years. During this time, SBA has grown their revenues by 41% and their cash from operations has grown by 51%. This is consistent growth for both of these, and this is a check on metric number 2. Metric number 3, we're looking for decreasing shares outstanding. Many REITs tend to be externally funded, meaning they're either issuing shares or raising debt to fuel their growth. In the case of SBA, they're somewhat atypical in that they have not been issuing shares. In fact, they've been buying back their shares. During their last 5 years, SBA has bought back 6% of their shares outstanding. As a shareholder in the business, this would increase your ownership percentage, which would increase the percentage of SBA's cash flows that you'd be entitled to. This is usually a strong sign, and this is a check on metric number 3. Metric number 4, we're putting some of our previous metrics together. Here we're looking for cash flow per share growth in the last 5 years. SBA has grown their cash flows by more than 51% during this time, and with their 6% share buybacks, this has led to pretty strong cash flow per share growth. Another check here on metric number 4 means that through our first 4 metrics, we have 3 checks and only 1 X for SBA. Metric number 5, we're evaluating the business's debt. During economic downturns, it's overly levered businesses that are likely at the greatest risks of poor outcomes. We want SBA's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of cash from operations the business has produced in their last 5 years. During this time, SBA has significantly increased their net debt position. Right now, they have $15 billion in net debt, and in the last 5 years, SBA has only produced $5.4 billion worth of cash from operations. While this has been growing, the company has roughly 3 times the amount of net debt that their cash from operations look like it's able to support. This is an X on metric number 5. At a glance, it looks like the business is very highly levered. To figure out if this may be an issue for SBA or not, you'd want to dig into the company's filings. they'll break out this debt profile in more detail, providing information on how this debt is structured, when it matures, what rates it's at, and if there are particular covenants associated with the debt. That would be worth your while to dig into. Before we get to metric number 6, it's time for our bonus. As our bonus, we're looking at SBA's dividend profile. SBA currently pays a 1.2% dividend yield. We're looking to see if this is supported by their cash flows. SBA has paid dividends in 4 of the last 5 years, and in all 5 of these years, they've supported a growing dividend payout pretty easily using their cash flows. A company can use its cash flows to make acquisitions, buy back shares, pay down debt, reinvest into the business, or pay dividends. Keep in mind those competing uses of cash flows, especially when it comes to SBA's debt situation. While this is a snapshot of their last 5 years of performance and it's no guarantee for the future, it does look like SBA is easily able to support their dividends using their cash flows. Again, be mindful of those competing uses for cash flows. The big metric of them all, metric number 6, we want their average cash from operations to their total enterprise value to give us a yield that's above 5%. If this is the case, this may provide a slight risk premium to the yield of the 10-year treasury. It may offer a reasonable starting point for a valuation of SBA. Currently, SBA has a $41 billion total enterprise value. This takes into account both their market cap and their high net debt position. It gives a perspective of SBA similar to it being a private business. In the last 5 years, we learned SBA produced $5.4 billion in cash from operations. In an average year, they're producing about $1.1 billion in cash from operations. When we divide that by their $41 billion total enterprise value, that gives about a 2.6% average cash from operations to enterprise value yield. On a current basis, SBA has produced $1.3 billion in cash from operations in their most recent fiscal year. When we divide that by their enterprise value, we get a 3% current cash from operations to enterprise value yield. Both of those are coming in below the yield of the 10-year treasury. They're below the risk premium we'd be seeking, meaning this is an X on metric number 6. Just because this is the case doesn't mean you're throwing this business out. This is not a buy or sell recommendation of any security. It's not financial advice. Wait till the end as we come to both a more concrete estimate for SBA's intrinsic value and we give a final rating to the business. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze SBA, which takes us on to using a discounted cash flow model to come to an estimate of SBA's fair intrinsic value. A DCF model is based off the predictability of a company's cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with SBA's current cash flows and using historical growth assumptions to project those into the future. It's up to you to do your own homework here to figure out if these are accurate or not. Assuming they grow their current cash flows at 9% annually for the next 10 years, then assuming this growth rate is cut in half to 4.5% over the next 10 years, we won't be adding in the company's tangible book value as that's skewed based how the accounting is done for both the debt that the company has in addition to their share buybacks, so it's not that representative here. If we were seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for from his investments in addition to his margin of safety requirements, at today's valuations, it looks like an estimate for SBA's fair intrinsic value is only around $112 per share. That would be cutting their current stock price by more than half. There are key factors to note here. SBA has been a very predictable business in its past. That's no guarantee for the future. However, the unit economics of these tower businesses and the overall cell tower market does tend to lead toward being more predictable, especially compared to other types of businesses. While it makes up only a small part of their 15% discount rate, their dividend yield would be included in this discount rate, as we would not be doubly counting the company's dividends. Again, keep in mind this is only an estimate and their tangible book value was skewed here. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Before considering an investment decision, consult with your financial advisor. In just a minute, we'll give our rating to SBA, but we have to address something first. What are the qualitative aspects of the business? Starting with the key factors supporting a potential long thesis. Number 1, long-term carrier leases with built-in escalators leave SBA with greater visibility into its continued revenue growth and provide a floor to financial results. Number 2, wireless network development in SBA's international markets is behind the United States and will require more tower investment by carriers as they transition to broad 4G and then 5G coverage. Number 3, carrier investments in towers will have to continue as mobile data usage continues to grow rapidly. Greater use of the Internet of Things, 5G, and video content should keep this trend in place for years to come. Then for the factors supporting a potential short thesis. Number 1, SBA has an extremely concentrated customer base space, leaving it overly susceptible to carrier bankruptcies or consolidation, both of which would likely reduce carrier investment. Number 2, technological advances, less new spectrum to deploy, and a rolling off of Sprint contracts will keep US growth below historic levels for the next several years. Number 3, the company's extreme use of financial leverage could become problematic if the company were to face an industry downturn or a less favorable economic environment. There you have it for a balanced perspective of some of the key points surrounding SBA. Now it's time to give our rating. In analyzing SBA Communications, stock ticker SBAC, we've learned the business grew their revenues and their cash flows in the last 5 years. They bought back 6% of their shares outstanding. While they earned slightly above average returns on capital, the company had negative returns on equity, in part because of their share buybacks. SBA is levered at more than 3 times the amount of their 5-year cash from operations. This may or may not be a potential problem. It depends on how this debt is structured and when some of this would come due. On both a current and an average basis of their cash from operations to their enterprise value yields, those were coming in below the yield of the 10-year treasury. SBA has supported a growing dividend in the last 4 years, and if that were the sole use of their cash flows, it would look very healthy. That's not the case, and that has to be looked at relative to their other uses of cash flow. It's worth reiterating this analysis is not financial advice. Combining the factors of our analysis together, SBA looks like a moderate candidate for further research. When we performed our discounted cash flow analysis, if you've done the work and you believe those historical growth assumptions from today's valuations of SBAC, if you were seeking a 15% rate of return, an estimate of their fair intrinsic value is only around $112 per share. The company was last at those levels in February of 2017, meaning you'd have to be patient as you dig in and learn more. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, comment a business you want me to look at for next time. Thanks for learning about SBA with me, and have a great day.